Hey there. Today, we're jumping into a topic that is absolutely essential for your financial future: investments. Now, this isn't just about stocks and complex charts. This is really about building a solid foundation for your long-term wealth. So let's get right to it.
I want to start with a really powerful question. What if you could make your money work for you, instead of you always having to work for your money? That single idea, that is the entire promise of investing, and it's exactly what we're going to break down today.
So, here's our roadmap. First, we're going to cover the basics of what an investment even is. Then we'll follow the money to see how it moves through the whole economy. After that, we'll get into how we figure out what something's worth, tackle the classic game of risk versus reward, and wrap up with some key strategies for investing a little bit smarter. All right, section 1. Let's start at square one. What is an investment, really? To get our heads around it, we first have to understand that pretty much everything you can invest in falls into one of two big families. At its core, an investment is actually pretty simple. You're buying an asset, something of value, with one main goal: to put your money into it today, hoping and expecting that it will be worth more in the future. And this is a really fundamental split. On one side, you have what are called real assets. This is the actual stuff that creates economic value. Think a factory, a piece of equipment, or even an idea protected by a patent. Then, on the other side, you have financial assets. These aren't the factory itself, but they're the pieces of paper, the claims on the money that factory is making. We usually call these securities, and you know them as stocks and bonds. So how do all these assets fit together in the real world? Well, that brings us right to section 2, the great money cycle. Let's just follow the cash and see how this whole system really works. You can kind of see the whole cycle right here. It all starts with investors, right? They put their money into companies. Those companies then use that cash to fund projects, like building that new factory. If those projects are successful, they generate profits, which then flow back to the companies and eventually back to the investors. And of course, the government is always there, taking its share through taxes. It's this constant interconnected flow of money.
Now, if you look at it from the company's perspective, they're really in the driver's seat. They are making these huge decisions that keep this whole cycle going. They have to figure out how to raise the money in the first place, which projects are actually worth funding, and then, crucially, what to do with any profits they make. Do they give it back to investors, or do they reinvest it to grow even bigger?
But, and this is the twist that changes absolutely everything, behind every single decision, every step in this cycle, there is a giant, unavoidable question mark. The one and only constant in this entire system is uncertainty. Nobody knows for sure what's going to happen next.
And that uncertainty, that big question mark, it leads us to a huge question of our own, which we're going to tackle right now in section 3, the price of the future.
So let's just ask it directly. With all of these unknowns floating around, what is an investment actually worth? How do you put a price tag on a future that you can't perfectly predict? Well, the process for trying to answer that question has a name. It's called valuation. Think of it like a toolkit that investors use to try and estimate the current worth of an asset, even with all that uncertainty about the future. And here is the single, most important idea behind all valuation. The price you pay today for any investment is simply the present value of all the cash that's expected to generate for you down the road. You are literally buying a claim on future money, and its price today is your best guess of what that future stream of cash is worth right now. Because $1 tomorrow isn't the same as $1 in your hand today, right? That's the key. But that phrase, expected to generate, it's doing a lot of heavy lifting there. It is loaded with uncertainty, which brings us straight to section 4, the risk and reward game. This is the fundamental trade-off that is at the heart of every single investment you will ever make. So here's the core idea of risk in a nutshell. There is almost always a gap between what you expect to get from an investment and what you actually get. Let me just walk you through a quick example. Okay, so let's imagine you invest $100 in a company called We Say So Corp. You expect to get a $2 dividend check, and you expect the stock price to rise to $105 by this time next year. If you add it all up, your expected return is 7%. That's the plan. That's your hope. But of course, reality often has other ideas. A year goes by, the company actually paid a slightly better dividend, $3, but the stock price only went up to $103. Your realized return, what you actually walked away with, was only 6%. That 1% gap between what you hoped for and what you got, that right there is investment risk. And sometimes that gap isn't just 1%. Sometimes it's absolutely massive. Risk is a two-sided coin. On one side, you have the devastating downside, the risk of loss, like when Enron's stock basically went from over $90 to zero. But on the other side, you have the upside, the possibility of huge, unexpected gains, like when Amazon stock once leaped 14% in a single day. So, if risk is just part of the game, what are we supposed to do about it? Well, that leads us into our final section, Section 5, Smarter Investing. Let's look at a couple of core ideas for how to navigate this world of risk and return.
The first big idea is something called the efficient market. Now, this theory basically says that in a competitive market like the stock market, prices already reflect all the public information out there. So what's the big takeaway for you? It means it is incredibly difficult to consistently beat the market because any obvious good deal gets priced in almost instantly. So if we can't really expect to outsmart the entire market all the time, what's our best strategy? Well, it starts with a really powerful idea from statistics, the law of large numbers. Just think about flipping a coin. If you only flip it a few times, the outcome is totally random. You might get heads 4 times in a row. But as you can see here, as you flip it hundreds or thousands of times, the result gets incredibly predictable and smooths out to be almost exactly 50-50.
And this is the exact same logic behind diversification. And this is probably the single most important idea for the average investor to understand. The performance of any one stock can be wild and unpredictable, just like those first few coin flips. But when you combine lots of different, unrelated assets into one portfolio, their individual ups and downs, their unique risks, they start to cancel each other out. And the result is that your total portfolio's return becomes much smoother and more predictable over time. It's really your best defense against the risk of being wrong about any single company.
And that brings us full circle. We've seen all the building blocks now, the different types of assets, the way cash flows through the economy, how we try to value an uncertain future, that constant tug-of-war between risk and reward, and finally, a core strategy to manage it all. So what's the one big question this all leaves us with?
It's this one. What level of uncertainty are you personally willing to accept in order to get the future you want? Because at the end of the day, answering that question for yourself, that is what investing is all about. Thanks for tuning in.